Hold on to your stacks, folks. Silver just got absolutely nuked. $300 billion in paper value vaporized in mere minutes. From a scorching high of $120 per ounce, it plunged 37% to $76 in one brutal session. If you bought the top, you're bleeding right now. Thoughts and prayers to the leveraged longs who got margin called into oblivion. This is the second worst day in silver history, folks. Straight carnage. But wait, is this the death of the silver bull? The end of the run that's tripled prices in a year? Or is this the ultimate setup for the biggest squeeze you've ever seen? Stick with me, because I'm breaking it all down. The why, the how, and how you come out on top. This ain't random, my friends. The big boys are shaking out the weak hands, and you're about to be the exit liquidity if you panic. Let's dive in. First off, what the hell just happened? Silver was on fire, up 170% in a year, smashing records left and right. Then bam! Friday, January 30th, it all comes crashing down. Why? Let's keep it simple. Number one, the dollar spiked like a rocket. DXY jumped 0.9% overnight, thanks to Trump's bombshell Fed chair pick. Kevin Warsh, the hawkish beast who's all about crushing inflation. Markets freaked, thinking easy money's over. Stronger dollar? It's like a massive seesaw. When the greenback goes up, silver gets crushed down. Simple physics, folks. Number two, margin calls turned into a domino apocalypse. CME hiked margins not once, but twice in January, from flat dollars to 9%, then 11%. That's killer for leverage traders. Imagine you're holding a 5,000-ounce contract on borrowed money. Price surges to $120, and suddenly you need way more collateral. Can't pony up? Boom. Forced liquidation. Cascade effect. One sell triggers another. Prices tank, more calls, total wipeout. Speculators who piled in got flushed out hard. This is not random. Exchanges like CME are protecting the house while you bleed. Number three, profit taking. After that parabolic blow off top. Silver doubled in 2025, then rocketed another 60% in January alone. Greed turns to fear fast. Add in Trump's tariff threats rattling global trade. Geopolitical chaos with China reclassifying silver as a strategic mineral, restricting exports, and boom, risk-off mode. Tech sell-off? Yeah, that spilled over too. Earnings jitters, bond yields spiking, it all piled on. But here's the conspiratorial twist. Bullion banks short massive positions. Love this. COMEX registered silver, only 105 million ounces against 490 million in open interest. If even 20% demand physical, it's game over for the paper game. They needed this flush to survive. I know it hurts right now. We've all been there, staring at red screens, questioning life. If you're down 30% overnight, it feels like the world's ending. But breathe. This is where empires are built. Remember, this exact same thing happened before. Flashback to 1980. Hunt Brothers corner the market. Silver hits $50. That's like $200 today. Then crashes 90% in months. What happened next? It stabilized, then surged over ninefold in the following years as inflation roared back. Or 2008 crisis. Silver tanks 60% from $21 to $8. Then rockets 448% in 2.5 years as the Fed prints trillions. 2011 drops 55% after peaking at $50, rebounds hard. Even 2020 COVID crash, silver dives from $18 to $12 in weeks, then doubles in 5 months, triples by 2021. History screams, crashes shake weak hands, then explode higher. This dip, it's the fuel for the next leg up. And folks, the long-term fundamentals, they're on fire, bullish as hell. Forget the noise. Silver's not just money, it's the backbone of the future. Supply, chronic deficits for the 5th straight year, 95 million ounces short in 2025, and 2026 looks worse. Mine production flat, recycling can't keep up. China's export curbs, that's fragmenting the market, creating physical shortages everywhere. Central banks, they're stacking gold, sure, but sovereign funds and institutions are hoarding silver quietly. De-dollarization's real, folks. They know the dollar's losing grip. Demand, exploding. Industrial use, over half of silver's gone. Solar panels alone gobble 125 million ounces in 2026, up huge as green energy booms. EVs, each car needs 1 to 3 ounces more than gas guzzlers, 75 million ounces from autos alone. AI and data centers, surging, US and China ate 350 million ounces last year for tech, over half the mine supply. Grid upgrades, batteries, electronics, it's a perfect storm. Geopolitical chaos, wars, tariffs, uncertainty, silver's your hedge. This crash, it's not killing demand. It's making physical cheaper for the big buyers who'll squeeze shorts later. So, probabilities? Here's my breakdown. 65% chance we rally hard next month. Shorts cover, dip buyers flood in, prices rocket. 25% more pain to really shake the weak hands, maybe to $70, liquidate the last holdouts, 10% sideways chop while markets digest Trump's Fed drama. But mark my words, this sets up massive upside. My bold prediction, by mid-February, silver will smash back above $100. Yeah, you heard it. From $76 wreckage to triple digits in weeks. Shorts will burn, physical demand will crush supply, and we'll see that squeeze ignite. Screenshot this, folks. When it hits, tag me. But listen, don't be a hero. Here's your power move advice. Ditch leverage now. It's a killer in volatility like this. Stack physical if you can. Bars, coins, the real deal. Papers getting exposed. Buy the dip smart. Not all at once. Dollar cost average in chunks. Watch key indicators closely. DXY for dollar moves. Fed speeches on Warsh's hawkishness. China export data for supply shocks. Stay vigilant. The game's rigged, but knowledge is your edge. The brutal reality, silver just got obliterated. 300 plus billion vanished in a flash. Listen up, because this one hits hard. Silver just suffered one of the most savage beatdowns in modern history. On Friday, January 30th, 2026, the white metal plunged a staggering 31 to 37% in a single session. Futures settled down 31.4% at around $78.53, while spot prices cratered as low as the mid-80s after touching parabolic highs near 120 tau just days earlier. That's right, we're talking the worst single-day drop since March 1980, or even the second worst on record depending on how you slice it. In dollar terms, the biggest daily wipeout ever recorded for silver. Trillions in paper dreams? Nah, hundreds of billions wiped out overnight. Do the math on this carnage. With silver's massive market cap after that insane run-up, tripling in value over the past year, surging 170, 250% in some stretches, this crash erased roughly 300 billion or more in paper value in mere minutes to hours. Leveraged traders? Absolutely destroyed. Margin calls hit like a tsunami. Forced liquidations cascaded, one sell triggering the next, turning screens blood red faster than you could refresh. If you bought anywhere near that blow-off top, man, you're hurting right now. Deep red portfolios, sleepless nights, that gut punch feeling like the market personally betrayed you, thoughts and prayers to everyone who got shaken out. We've all stared at those brutal losses before. Weak hands, shaken. Exit liquidity, you were it, and the big boys knew. This wasn't some gentle pullback, it was a full-on flush. Every man and his dog rushing for the exit, as one headline screamed. Speculators who piled in late chasing the hype, flushed hard. Bullion banks and shorts on COMEX. They breathed a sigh of relief as open interest got wrecked and physical delivery pressure eased. Remember those tiny registered stocks versus massive futures? You're the exit liquidity here, folks. The system designed to protect the house while retail gets rinsed. It's not random. It's engineered chaos to clear out the over-leveraged dreamers before the real move. The emotional gut punch. But this pain? It's temporary fuel. I get it. Staring at 30% plus losses overnight feels like the bull run died screaming. If you're down big, it stings, questioning everything. But here's the flip. This exact level of panic is where legends are made. The weak hands are gone. The over-leveraged are toast. What's left? Real believers with dry powder ready to stack at these fire sale prices. History shows these bloodbaths don't end the story. They reload it for the next explosive chapter. This wasn't some random glitch in the matrix, folks. The SilverCrash was a perfectly orchestrated takedown, layered like a pro wrestler's finishing move. The big players needed this flush, and they got it in spectacular fashion on that brutal Friday, January 30th, 2026. Silver didn't just dip, it got obliterated, plunging 31-37% in one session. Futures settling around $78.53, after touching highs near $121-$122 just days earlier. Spot prices cratered into the mid-80s before bouncing a bit, but the damage was done. Hundreds of billions in paper value torched, leveraged traders margin called into the abyss, and retail investors left holding the bag as exit liquidity. If you're still staring at those red numbers, know this, it hurts because it was designed to hurt the weak hands the most. Start with the obvious trigger that everyone screamed about. Trump's nomination of Kevin Warsh as the next Fed chair. Warsh, the inflation hawk who's all about central bank independence and crushing easy money vibes, sent shockwaves through the markets. The second Trump dropped that name on Truth Social, the dollar exploded. DXY spiked nearly 1% in hours, one of its biggest daily jumps in ages, reversing months of weakness. A stronger greenback is like kryptonite to precious metals. Everything priced in dollars gets more expensive for foreign buyers, demand dries up fast, and the seesaw tips hard against silver. Traders who were betting on endless dollar debasement, the whole Fed will print forever, metals to the moon narrative, got smoked. Warsh's pick eased fears of Trump turning the Fed into his personal piggy bank, so the dollar rallied and silver paid the price. But that's only part of the story. The surface-level headline they fed the masses. Dig deeper, and you hit the real killer. Margin hikes from the CME group that turned leveraged positions into ticking time bombs. Back on January 13th, they switched from fixed dollar margins to a percentage-based system, starting at 9% of contract value. Then, bam, on January 27th, they cranked it to 11%. That's not a tweak. That's a guillotine for anyone trading on borrowed money. Picture this. You're long a standard 5,000-ounce silver futures contract. Price rockets to $120, your margin looks safe at the old levels, then suddenly you need 11% more collateral overnight because the price is higher and the rules changed. Can't meet the call. Forced sell. One liquidation drops the price a bit, triggers more calls on others, cascades into a full meltdown. Thousands of over-leveraged specs got flushed in minutes. The exchange protects itself first, always, while the little guy gets rinsed. This wasn't accidental. It was timed perfectly to coincide with the dollar spike. Then pile on the classic blow-off top psychology. Silver had gone absolutely nuclear, up 170-250% in a year, 50 to 60% just in January 2026 alone after tripling the year before. Parabolic moves like that scream greed, and greed flips to fear lightning fast. Profit-taking hit hard. Smart money locked in gains at the top while latecomers chased the hype. Trump's tariff threats rattled global trade. China's moves to classify silver as a strategic mineral hinted at export curbs, and a spillover from tech stock jitters added fuel to the risk-off fire. Everyone rushed the exits at once. Every man and his dog, as the headlines brutally put it. But here's the conspiratorial layer most won't admit. The paper market on COMEX was screaming for relief. Registered physical silver in COMEX vaults, a pathetic 105 million ounces or so against open interest representing hundreds of millions in paper contracts. If even 20 to 22% of those futures holders stood for delivery, the shorts, bullion banks and big hedgers, would face a nightmare squeeze. Physical shortages were building, demand from industrials, solar, EVs, AI data centers was devouring supply. Chronic deficits for years, mine output flat, recycling nowhere near enough. The shorts needed breathing room bad. This crash liquidated longs en masse, cratered open interest, eased delivery pressure, and let them cover or roll shorts without blowing up. JP Morgan and the bullion banks, they breathe easier now. Retail, you were the cannon fodder. Exit liquidity to keep the paper game alive a little longer. Put it together. Hawkish Fed pick plus dollar rocket, plus engineered margin squeezes, plus profit-taking panic, plus short position survival mode. It wasn't coincidence. It was a multi-front assault to shake out the over-leveraged, overhyped crowd before the fundamentals reassert. History proves these setups every time. 1980, Hunt Brothers Corner. 2008, crash. 2011, peak. 2020, COVID dip. Massive flushes, followed by explosive rebounds as real demand crushes the paper manipulators. The pain today is visceral, but it's clearing the deck for the next leg. The big boys rigged the flush to reload cheap. Now you know the game. Don't panic sell physical. Stack more if you can. Ditch leverage forever in this volatility. The squeeze is coming. Stronger dollar or not, supply deficits and exploding green tech demand don't care about Fed chairs. This crash, just the setup for your biggest win yet. Stay empowered. Stay stacked. The pain from that savage silver crash is still fresh. Prices cratered from those insane January highs near $121, $122 down to around $76, $79 as we speak on February 2nd, with futures hovering in the mid-70s after another rough session. Screens are blood red, portfolios are scorched, and if you were riding leverage or chased the top, you're feeling every ounce of that gut-wrenching drop. But here's the flip that separates winners from the shaken-out crowd. This isn't the end of the silver story. This is the classic reset. The violent flush that clears weak hands, resets over-leveraged positions, and sets the stage for the next massive leg higher. History doesn't lie, and the fundamentals are screaming bullish louder than ever. Every major silver crash has been followed by explosive rebounds, and this one looks primed to deliver even bigger. Look back at the patterns. They repeat like clockwork. Take 1980. The Hunt brothers squeezed silver to $50, equivalent to over $200 adjusted today. Then it crashed over 50-90% in months as regulators and margin calls crushed the play. What happened next? Silver stabilized, then powered higher through the inflationary 80s, delivering multifold gains for those who held physical and bought the fear. Or 2008, global financial meltdown tanks silver from $21 to under $9, a 60% wipeout. Weak hands panicked, but the Fed's money printer went brrr, and silver exploded 448% in the following years, hitting $40 by 2011. 2011 peak at $50, dropped 55-60% in the correction, then rebounded hard as QE infinity fueled the next wave. Even 2020 COVID crash. Silver dives from $18 to $12 in weeks amid liquidity panic, then doubles in 5 months, triples by 2021 as stimulus flooded in, and industrial demand roared back. Each time the script is the same. Brutal flush shakes out leverage addicts and late speculators. Physical demand absorbs the dip, and prices rocket as supply can't keep up. This January 2026 bloodbath fits the mold perfectly. The crash wiped out the blow-off top froth, that parabolic 50-60% January surge after tripling in 2025. Over-leveraged paper longs got margin called to death. Open interest on COMEX got hammered, and the system gave the shorts their desperately needed relief. But the core drivers? Untouched and accelerating. Supply is in chronic structural deficit for the 5th straight year running into a 6th. Estimates peg 95 to 200 million ounces short annually, with mine production flat or barely growing, because most silver is a byproduct of copper, lead, zinc ops that aren't ramping fast enough. Recycling can't bridge the gap. China's export restrictions kicking in January 2026. That's tightening the physical screws further. Strategic mineral status means less flowing out, premium spiking in Asia, and global availability getting squeezed. Demand side is on absolute fire, and this is where the long-term bullish case turns nuclear. Industrial consumption now dominates over half of total silver use, up massively since 2015. Solar panels alone are devouring 120-150 million ounces yearly, as the green energy transition accelerates worldwide. Every gigawatt of new capacity needs tons of the stuff for conductivity. EVs, each electric vehicle packs 1 to 3 ounces more than traditional cars, with adoption exploding. Projections say autos alone could pull 70 to 100 million ounces annually soon. Then layer in AI data centers, semiconductors, 5G infrastructure, grid upgrades, batteries, electronics, all gobbling silver at record paces. US and China tech buildouts are eating hundreds of millions of ounces combined. Geopolitical chaos, tariff wars, de-dollarization pushes. Silver's your hedge against all of it. Central banks and sovereign funds are quietly stacking. Gold gets the headlines, but silver's following the playbook. And investor inflows into physical bars, coins, and ETFs remain robust despite the dip. Forget the bearish noise. Some Wall Street voices are calling for a crash back to $50, but that's the same short-term fear talking that missed the entire run-up. The structural mismatch doesn't vanish with one flush. It builds pressure. Cumulative deficits since 2021 are nearing 1 billion ounces drained from above-ground stocks. COMEX and LBMA vaults are at multi-decade lows. Physical buyers, industrials, jewelers, institutions are stepping in at these levels, not panicking out. The paper game got a breather, but reality is catching up fast. Probabilities right now? I'd say 65-70% we see a hard rally in the coming weeks to months. Shorts start covering as physical demand bites. Dip buyers flood in with dry powder, and we smash back toward triple digits. 20-25% chance of more chop or a test lower to shake the last weak hands. Maybe low 70s if dollar stays bid. 10% extended sideways while markets digest the Fed drama. But the bias is clear. This dip is rocket fuel. My bold call stands. By mid-February or early March at latest, silver blasts back above $100, and that's conservative. We've seen 100-400% rebounds off these fear lows before. With today's demand supernova, this could be generational. The crash hurt, no question. But it empowered the prepared. Physical stackers win here. Buy the fear, smart, dollar cost average in tranches, ditch leverage forever in this volatility. Watch DXY for dollar weakness signals. China export flows for supply shocks, solar REV production data for demand spikes. The game's rigged against the impatient, but you're armed now. This isn't hopium. It's pattern recognition plus unbreakable fundamentals. The rebound isn't coming, it's loading. Stack while they're dumping. Because when the squeeze reignites, the weak will regret, and the stacked will feast. Stay empowered, stay in the fight. Silver's long-term fire is blazing hotter than ever.